showing. Now it's not showing. Correct. Oh my goodness. Are we ready now? All right. That was a whole lot of crazy. 3 computers, all these audio problems, all these connection problems, but we are going now. We've got the PowerPoint. So we've had, and actually I'm going to remove it up here because I'm staying way away from people. When I was trying to do this presentation, trying to put the last over 6 months of crazy into less than 30 minutes is about impossible, isn't it? I mean, there's so much stuff that's happened, and it's been like just a fire hose of information that I've been going through. So there's so much more I could talk about or could dive into that I won't be able to do this morning, but you're more than welcome to come back to me and say, hey, at the end of the conference, I'll put my mask on, and we can chat a little bit more in details. One thing, I really do like all the networking. You guys are doing a lot of great networking, but use it on social media. We do a lot on LinkedIn and Twitter, and I would put my favorite hashtag of 2020, and it is doom scrolling. I bet all of you did it this morning. You got on your phone and you look for what was the next bad news that's happening in 2020. I asked my 2 teenagers their favorite hashtags this year, and one said quarantine, and the other one says maskne, which is mask acne. It's a real thing for teenagers, by the way. So I'd love to hear your favorite 2020 hashtag, and I'll try to get on there later if that technology doesn't fail me as well. So and the sound's not working on that one, and I do need to get to work, but there you go. All right, here's the outlook from last year. So last year when I did my presentation, I came here and said, we thought the Kansas economy was going to go 0.6%. And you think, what in the world was I thinking about? Matter of fact, all last year I was thinking about when's the next recession. I had a lot of conversations about that. Matter of fact, when I did a survey of businesses last year, the majority of them thought we were going to be in a recession in 2020. However, when you asked them why, no one knew why we were going to have a recession. So last year's theme was a health checkup. And really the fundamentals were behind our economy. I even challenged this crowd to say, what do you think will be the recession for next year? And I had a few comments went around the state, but no one figured out it would be COVID. So unfortunately, our forecast was positive. The foundations behind it was really positive to go forward, and that didn't happen. Think about this year's theme. Only one thing came into mind: a Shakespearean tragedy, because this is what it feels like, right? All the way through. And every Shakespearean tragedy has 5 acts. So I'm going to break my presentation up into 5 sections. When you think about the supernatural forces for the first act, you think about Macbeth, and there's witches. Hamlet, there's ghosts. For 2020, it's COVID. So the first thing I'm going to do is talk about COVID. And we really need to pause a little bit and say, all that doom scrolling we were doing, what was real? What really happened? How much of that information do we need to really come back and process? Bigger picture here is industries. If January was 100%, you get April, you can see leisure and hospitality drop to 51% of where it was in January, so dropped 49%. Since then, it's been coming back up at the national level, all the way back to 76%. Now, I'm sure we have some bankers in here. The finance sector barely felt anything, right? They're the least impacted. And they were probably too busy doing PP loans and things like that to even notice if they got fired anyway. Next thing, when you look at the impact for different groups, and it impacted the economy in different ways, right? You go over to one side, you see by gender, females were impacted by this more. By race, it was minority. And if you look by education, it's lower education cohorts are the ones that were more impacted by COVID than other segments of the population. Now, why is that? Most of it's driven by that leisure and hospitality, right? It was an industry-driven effect that had the shutdowns that impacted them most. The concern behind this is that if we're going to lose these jobs, if we're going to have more teleworking, if it's a permanent part of our world going forward, and I heard a podcast to begin about New York, about people just exiting New York right now. You have more urban densification and automation forcing. You have all these factors. You're going to hurt a segment of the economy, because in these dense urban areas, even in urban areas like in Topeka and Kansas City, Do you know where you have upward mobility? It's those secretaries and security guards and the leisure and hospitality sector, hotels, where people have a skill and then they can move up and get into a higher career, upward mobility. So there's some people saying we've got a risk of lost upward mobility in the Kansas or in the US economy. I'm actually going to give you a different point of view throughout my whole presentation. Just like Shakespeare, the beginning of the play is different than the ending of the play. This is such a different event. If this was a few years ago when we were destroying because of teleworking, I would say yes, we'd have a real issue of upward social mobility. But I think it's a different world as we go forward. This one is shocking. Look at how much incomes went up second quarter. And by the way, look at the scale. I didn't touch the scale at all. Incomes went up dramatically in second quarter of this year. Even for Kansas, for Plains, it doesn't matter. What are the components of those income? Well, I didn't put all of them, but the biggest driving factors is earned income, wages is part of it. And it looks like it dropped a little, but it actually dropped a whole lot. Another one is transfer of payments. The reason why income went up so much is those federal transfer payments and state unemployment insurance claims and other ones that came flying through to this economy. Now, why do I show this? It's because if you were thinking the economy was doing better this summer, or as we went into the fall, the economy is doing better, it's really because all this cash was pushed through into transfer payments, into households, into spending, and keeping the economy afloat. When you look after July, when unemployment insurance dropped, if I looked at this monthly, I don't have it for the state monthly, past July into third quarter, you can already see transfer payment drops, earning income is still way down, and you can see the economy slowly dropping off. What's floating us is all this income we had in the second quarter, savings went up, and we've been using savings to float the economy the last couple of months. And if we don't get a federal stimulus, we're going to really feel what it hits like when we have less income in the economy. It's going to go back to those same sectors we looked in the previous slide. All right, how was Kansas impacted by this recession? And you can see on the employment side, you can see employment came down a little bit at the Kansas level and the US level a lot less. Now I will tell you, when I was asked back in April to do an impact study and then May to update our forecast, I thought Kansas was going to decline by 10.2%. I thought some regions of the state was going to decline by a whole lot more. So when I did the impact side, I think actually my numbers are actually somewhat right. We just got it wrong on the employment side. And I'm going to tell you why I got it wrong on the employment side. There's a few things. First, the PPP loans. I did not expect Kansas. I had to take a simplifying assumption, but I did not expect Kansas to get more of it than other states. We got a lot more PPP loans. We also got a lot more federal stimulus loans than the nation did, which if you want to see those, I have slides on those. I just didn't put it up here. Right? Well, those PPP loans help protect a lot of jobs. And it makes sense. We had really hard hit sectors in Kansas. They protected jobs and they kept it secured a little bit more than I expected. So we lost less. Another thing that I didn't expect is how well capitalized Kansas companies are, which I'll show you later. We have more cash on hand going into this recession, and we were already a tighter labor market. That means we already saw our labor as critical, and we couldn't let them go. And so we held on to labor. All right, so the COVID has this big shadow on the economy, and it's going to cast this shadow on it until we have a vaccine and dissemination. Now, I didn't do this forecast, but if you want to check a really good forecast, they update it almost daily, is this good judgment. And they pay people not to be experts, but to use their judgment of what's going on, of what they see, all the news and information of how to determine, and they get paid for accuracy, right? If you look at this, that means the chances of us to get a vaccine and dissemination, 53% expected to be the end of this school year, and another 38% expected to be beginning of next school year. So unfortunately, we have a long road ahead of us before we get a full vaccine and recovery from this. This is going to be the shadow hanging over our economy. All right. The first one we talk about is supernatural forces. And we talk about the supernatural forces. Think about Shakespeare. He never lets a natural force to be the whole theme of one of his plays. It's always a side feature. It's something that influences the character. And that's what I'm going to talk about next, the labor market, right? Kansas is not going to be defined by COVID. We have companies in here who's not going to be defined by COVID, although at this point, you feel like it is influencing your life so much, you feel wrapped around it, but it won't do that. So the next one I'm going to talk about is character and the labor market. Now, this is unemployment claims. If we look at back in April at the national level, unemployment went up to 14.7%. It came down, right? So labor market's improving, definitely not where it should be, but it's improving. Another way to look at it is we lost around 22 million jobs. We gained back about 11 million jobs. So there's still people out there that are unemployed. Now, here is another lens to look at it, and I like this one a lot. This is initial unemployment claims, and I divided by per 1,000 workers in it. So what it tells me all the way back in January, per 1,000 workers in construction, there was 5.6 that had initial unemployment claims back in January. That's off-season. If you want to get a really good idea what a tight labor market is, this is one labor market economy back in January. Very, very tight, no one available at all. You move forward all the way to the end of March, you have a very different economy, right? So in manufacturing at the state level, for every 1,000 workers in manufacturing, almost 85 had initial unemployment claims in that week. Go all the way down to accommodations and food services, it gets down to 92. It's a very different economy. In that context, it was the shutdown of this economy. We're just experiencing it. You move it forward to today, or the closest one I had, and you see another different labor market than it was before. I'm saying this, I want you to disconnect the idea that we're still under the same labor market of COVID. It's changing, it's more dynamic. As we move forward, these other sectors of the economy are noticing that demand has diminished, right? As demand has diminished, they're changing labor, and they're now laying off some jobs. So you see initial unemployment claims relatively increasing in some of these other sectors of the economy. Going back to these different segments, here's initial unemployment claims. You look at gender in Kansas, they both peak pretty close to each other. And now look what it looks like today. Men are being more impacted. Why? It's the manufacturing side. Manufacturing is now laying off more people. That's why I'm saying the labor market's changing. Look over here by race. It's less of a minority issue. It is one race that's being highly impacted by COVID in Kansas, and that's Black, and it's increasing. These next two on the right side are actually really interesting. You might not have guessed this. If you look at today, it's people later in their career and have more education who's being laid off today, proportionally to the number of people available, right? So this is telling us the labor market's changing. A business perspective, if you need labor going forward, this is the time to soak people up with a lot of talent and a lot of skills out there, because we're laying people off at higher skilled levels. I will say, just as a pause, I know we've had this conversation here in Pittsburgh about getting more skilled labor. And by the way, this is an opportunity to increase more skilled labor here. Even if they're not physically here, you have people around the state that might be able to work and add to your labor pool. A conversation I know we've had before. All right, the census does a survey, and they had a survey on this depression, anxiety, and finances of households, and then here, this one is food scarcity. And all of them, you can see at the national level and Kansas level, they went up, they're remaining pretty high. If we compare us on all those factors, we were less than the nation. So this is good news. Our households are doing better than the nation. This is one that I found that I thought was pretty interesting, and it was food scarcity. If someone was laid off or they were furloughed, the percent of our households that were in those categories that then said they often did not have enough food to eat was much higher than the nation. Now, this is a community problem, right? As we still see furloughs and layoffs, and they're still happening in the state, then you have households that are now struggling. And if community level, the longer you wait, the harder it gets to crime and gets on for them re-entering the labor market and other social issues. All right, if you've been to any of these events over the last 11 years, you know that I love, instead of unemployment data, the unemployment rate, I like the employment population ratio. It tells us so much more. You can't hide from it. So on the unemployment, particularly this region, you can have someone who's laid off and they stayed off for a very long time and don't look for a job. They're no longer a part of that labor market, right? In here, you can't hide from it. You're unemployed, that doesn't matter. We're just looking at total population by total employment. And you can see that at the national level, it kept improving year over year. In Kansas, we were kind of flat for quite a long time. And finally, at the state level, started in 17, we started really improving. 18, it started doing better. 19 was doing better. We were just finally coming back up to where we were before, of really utilizing everyone who's physically in our state. And then you can see COVID, it drops and it comes back up. The takeaway on this, there are people out there available for jobs. Now, why do I say this? Because I know some of you are already thinking about this, because I did a roundtable for businesses, and they said, employers said, I have jobs, and I can't get anyone to fill them. And it is not talking about high-skilled jobs, middle-skilled jobs, lower-skilled jobs. They can't find someone to fill that spot. Well, and then you also probably know someone on the household side that says, hey, I've been putting my applications out. Why can't I get a job? There's too much competition for the same job that's out there. Now, when I did the panel, and even myself, we first thought the issue was, go back several slides, unemployment insurance claims, that $600 from the federal, it's probably preventing them from being the labor market. But then what, actually, I'll tell you a side story. I was asked to do that right when the federal unemployment insurance came out. I looked at the measurement for Kansas. It was almost 78% of Kansans were better off on unemployment insurance than getting paid by their job. It was the majority of Kansans were better off getting unemployment insurance. It was so high. I thought, this is not good. However, although the research already showing that the fear in the market has kept us engaged. Those people who were laid off were actively trying to get back into it. Not everyone, but most people were staying engaged. Unemployment insurance dropped in July. And although those people who were already laid off, they were already pretty tight, they did not have those savings built up. So they've been very engaged in the labor market. So there's really not a sign that the unemployment insurance is really what's prevented us from doing it. It's an easier answer. It's actually just such a massive shock to the labor market that this whole, just think about a puzzle. Think about two puzzles during Thanksgiving being thrown on the coffee table together. First, you have to sort out the pieces by each puzzle, and then you're going to start putting back together. There are other parts of the Kansas economy where the labor market had structural issues. We laid off jobs that will never come back, or physically in that area, like Topeka or in somewhere in western Kansas, they laid off jobs that would never come back. And it took them not months or years, it took them years to start really healing that labor market. Because the first thing that has to happen is the business has to know where going to have jobs. Then they have to increase wages to give the price signal to tell them to go over to it. Then households have to see that price signal, say, hey, I want to go get training. And that training could be a few months, a few years, or multiple years to get back into that, to refit in that labor market. So our issues is our labor supply and our labor demand, they don't fit within a regional economy or within an industry. And that's the rub that's going on. That's the friction. We just had such a shock that it scattered all these pieces and we don't know how to match them up. And it's going to take time to heal that labor market. All right, bigger focus. Let's look around the state. Here's employment by region of the state. And you can see a very clear theme. All the urban areas are the ones that got hit the most by employment. The urban side, they had shutdowns, and they're coming back up at almost the same rate. You look at more rural areas, they're either back at zero or a little bit above zero because a lot of that food manufacturing was important, agriculture is important, jobs are being created. They couldn't fill jobs over the last couple years, and now all of a sudden we had movement of jobs back to some of these other parts of the state because they weren't having to compete against the high urban wage price. All right, Act 3, the dichotomy of good and evil. Now, on here we have great industries. We have so many interesting stuff that we're doing that's doing great, but just like you see in all the Shakespearean plays, that when you add in a supernatural element, like Macbeth, they go from good to bad over time. And what we don't want is to see these industries really struggle and go and start being negative and hurting our economy. Now, I know I'm not supposed to show this many numbers or this many variables on one slide, but as an economist, I mean, this is the most beautiful thing ever, so you have to just appreciate it with me. The higher you're on this list, this is the ones that were the most impacted. You see the arts and entertainment at the very top. On the very left side is year-over-year employment. That's it. So you can see right when COVID hits, and arts and entertainment remained negative this whole year. But let me give you a different view. If you look at month by month, it shows you a different picture. Right after we had the shutdown, it's been growing and expanding and expanding and coming back. The top ones in the sector, they had a very visual hit, right? Because of the shutdown, and they're improving. However, remember I said demand is shifting, and these other sectors down here are realizing, uh-oh, I'm now going to start laying more people off. I did this as a visualization to show you how the market is changing up. All right, remember when I talked about the employment side and said, hold on a little bit, I think my numbers are still somewhat right. I thought employment should decline by 10.2%. When you look at how much GDP, the value of goods and service, The national economy in second quarter declined by 31%. Kansas declined by 30.2%. So when I did my impact, and you do a per person per output kind of variable, the state really should have declined closer to that 10.2%. Is those PPP loans, is holding on finances that we kept on labor. And I actually had in our model saying, yep, manufacturing is going to be the biggest one. That's going to have the biggest drop. Health, I don't think I had necessarily that high, but I had health actually pretty high on our model, saying lots of output loss there, right? So the takeaway here is we held on to labor. As we move forward, it's going to be different than the nation. The nation had just the shutdown of sectors that coming back online. We have an issue with manufacturing that, by the way, is going to take a lot longer to come back online for the state. When I say manufacturing, I should say on the durable side, not the non-durable side. The durable side is having supply chain issues, trade issues, just-in-time issues, because they had planned to be so lean. Now they're so lean they can't get inputs into their company and exputs out. I mean, they're struggling. Just-in-time was perfect before, and now how do I get more storage? Oops. All right, they did a survey of businesses. Good news, when they did the survey from census, showed the businesses that by establishment level, not as total value, they were less impacted in Kansas than the nation. And this is the one that says, and there's a lot more variables, we're more financially capitalized and better off to go into a recession than the nation was. Our very conservative nature. I took this information plus that employment question and said, hold on, when I did my panel of businesses, this doesn't make sense. Why didn't you lay people off like the nation did and just use that money and use your other money to make big investments and start really pivoting your company? And they said, no, we understand the risk. We needed to keep them. So we kept on our labor. And we're going to make small bets until we see a very clear growth in the economy. This is that nature, a very conservative nature that we have of our businesses in Kansas versus the nation. Very clear distinction of how we're different. Wouldn't you know it now, my clicker's dead. Know something else. You are about to be signed out. I sure hope we don't get signed out. Oh my goodness. I'm going to be signed out in 10 minutes. Well, all right. Well, here we'll go with it. So the next one, business see a tough road ahead. Let me go over here so I can see a little bit better. When I did the survey for the businesses and asked them, how are you looking at your finances? What are you looking forward? I said, yes, volume obviously dropped. It's going to come back up. Not for every industry, but it's coming back up. Input costs are going to be really hard on that manufacturing side. And when we look at prices they charge the customers, they are very clear. Can increase prices. And guess what they're going to do? Profit margins are going to start dropping for a lot of companies in Kansas. What's our forecast by industry? We actually have broad growth for the bigger industries, right? Even when you look subsectors, you can see some growth and decline. But I'm going to tell you right now, this forecast is not going to give you an idea of what really is going to go on in Kansas, right? The issue is you could be in a very high growth sector, not your high growth. You can be in a sector that's going to grow, but you could have made one small financial choice, and all of a sudden you're going to go bankrupt, right? So when you get to the bankers and some of the economic developers, this is the infrastructure that we need right now to really find on the micro level, not any macro level for an industry. It's the business side that's really struggling and could, even though they're in a growth sector, they could actually be derailed in okay, come on. All right, Act 4, fate and fortune. So one thing that Shakespeare likes, although he likes this idea of predestination, the hero gets to choose their path, right? And as I was showing you in the previous few slides, we have this very conservative. They're not ambitious like Macbeth, right? They're not overly ambitious. They're looking at the market just right, and they're going to go forward. They're choosing their own path, and they're being very careful about it. What businesses think they're going to do? I was surprised by this. They said they're going to increase wages. Remember that social mobility conversation I had earlier? When I sat down, I said, why are you increasing wages? It's that middle skill and that lower skilled. We really need them. This is the only way we're going to grow now. Rewind a couple years ago. Remember I've talked about wages before. It was higher skilled, things like that. It just switched again. Remember the social mobility? They're going to have to do training. They're going to have to do investments in these people. And guess what? This is going to create new opportunities. If that happens, that can grow your economy, that reinvestment in that labor. And so I was very excited to see that. Our forecast, as I showed you a few slides back, we think higher income, we're going to lose some. Lower income, it might improve, but overall, I think wages are going to be flat. For retail sales, this looks positive, but our retail sales have been muted for the last couple of years. It's really not that positive, although it's an improvement over this last year. All right, for job growth, businesses said, several industries said we're going to still lay off, but most of them are going to be pretty flat over this last year. This gets to our forecast, and I am sorry about this, but when you have all these political shifts going on and all this on COVID, we can't forecast those two. And that makes the widest range of our forecast that we've ever done. So here's one scenario, and both of them, by the way, requires a stimulus package for our economy to be stabilized. See this gray bar is almost zero, a little bit negative. That one scenario is this, is that we have a stimulus package, but we still have shutdowns or issues with schools that have contagion. We don't have a dissemination and vaccine anywhere in this through the school year, right? In this case, we're really struggling, a lot of negative sentiment in households. They're not spending. In that case, you should, if you see that coming on, our economy is going to be almost no growth over the next year. It should be pretty flat. On the other side, however, if we get rid of all this negative sentiment, particularly past the election, presidential election, we get confidence going in there. We're seeing that spending going on, and we have some clear out, not major outbreaks for COVID. We can have a lot faster growth in our economy than I'm expecting. Because of this, what I'm showing on the left and right is just the middle of the two. And that means we have a 0.5% growth, which is actually not bad growth for the Kansas economy. And then on the right side, you can see the cumulative effect. It's still way below, but we shouldn't expect to be back where we were in January. All right, Act 5, our last one, the paradox of disappointment. Shakespeare does one thing. Our human nature loves this idea of hope, and he just dangles it there and crushes it all the way through. I'm not going to crush it for you, by the way. I am going to give you a little bit of hope here because that is part of our human nature, and I think there is something interesting. Every time I do a presentation over this whole time, Sam says, which recession most looks like this? None of them do. But there's one, if you go back to the 1340s, you look at the Black Plague, there's some structures of the economy that shifted that actually has some unique parts to it now. Well, back then, in some areas, they lost about half the population. We're nowhere near that. They shuttered the economy much more than our economy got shuttered, right? But what happened? They had this feudal system. They had all this power at the top. And if you were a cobbler, the only one that could be a cobbler was your son, right? They had a clear delineation of who can move up in that labor market. What's happened in the last 2 decades in the United States? We had less social mobility. We have more income inequality. Well, back then, as soon as that happened, all of a sudden, the cobbler said, I needed someone, but my son died. I'm going to take someone who's a farmhand and train them and move them up. The highest increases in wages, the highest upward social mobility we've had in the world's history. We had a 100-year period where income inequality dropped significantly, right? And that's a good thing. It actually grew the economy much more. We've been dealing a lot of these things. I don't think we're going to be nearly as dramatic as then, but I think there's some issues here that we still need labor, and I'll show you later, and we can move forward and have a more productive labor market and economy. Look about growth. I wish I could show you really the entrepreneurs with all this household income, with all this savings. There's some people making all kinds of new investments and really being entrepreneurial. But this one shows business applications this year over previous year, right? And you can see that it is actually growing pretty fast. Even waged, new businesses with waged earners are already being employed, not just non-waged. So there's some great opportunity for growth. Here's another one for you to think broadly. We just had this teleworking, right? People, you just increased your labor market pool. The same issue that we're having a problem with now and right before COVID, we now have an increase to people with disabilities, those people who have issues with transportation, or regional markets, particularly here. Remember, we've talked about this before. You're having problems getting people here. They don't necessarily have to be here to make your companies more successful. So although we're getting more discouraged by teleworking, if we really keep adapting it, that opens the labor market. It keeps your wages actually more neutral for companies, right? They can be more competitive, and they can move forward with the talent they need. Next one, removal of rules and laws. I only put one up here, this telehealth. You can now be at home to talk to your doctor. But think about all the rules you had in your company that completely went out the window back in April, right? Those were inefficient. If you keep looking at those, get rid of those inefficiencies, you get rid of all that fat, and you're going to be lean to move around a little bit faster. Down here, consumer behavior, we know it's changed. Even the access to markets changed. Thinking back to my previous example of the Black Plague, we have large businesses that have dominated everything. This is an opportunity for medium-sized businesses and small businesses who already have access to that labor, who held on to it, particularly in Kansas, who got rid of all this unnecessary costs, who can find and move, adapt faster than the bigger businesses. They have the opportunity to grow. We have a lot more of those medium and small businesses in Kansas. The last one is business practices themselves. We didn't have we had really low productivity increases over the last decade. It just was so mute. We thought, well, what's going on in the labor market? We had all this software that we weren't using. Back in April, forced you to take it off the shelf and actually use all that software, right? If you get discouraged, you should really go back to it because it could increase productivity of your labor, particularly that lower and middle income earners can move up in the pay scale, right? Increased productivity pulls back to their wages. So here's some opportunities to really look at the market where businesses in Kansas can be more competitive. All right, I know I'm probably out of time, so I got to get moving here. Out of all this, I think there's a lot of creative destruction. We're going to have a tough year ahead, but the best statement I could say is ad astra per aspera, right? I don't think you can get anything better than that. And with that, I'm going to pause and try to flip this out so we get our next speaker on, and you can do an introduction why I do this little change, and hopefully everything doesn't just crash on me again. So thank you very much.
All right, thank you, Jeremy. We have two Jeremys on the program today. So our second Jeremy is Jeremy Hegle. And I'd like to introduce him.
All right, this is Jeremy Hegle. Can you all hear me okay?
It still has this new options.
Yeah.
It's not letting me click.
What's the deal with this? So there's no audio whatsoever coming through?
That's what, sorry, I had to jump up there.
This is Jeremy Hegle. I can hear you all okay.
Oh, great. Let me think about this. Okay, because I got this mic, my mic works over there, so we're good.
Okay.
Yes, so Jeremy, you can go,
So it's all good.
and we can see your slide, so we're good.
All right. So
All right, perfect.
Audio is just fake. We'll just put this on the speaker.
All right, well, thank you for having me. Sorry, I can't be there in person. I'm Jeremy Hegle with the Federal Reserve Bank of Kansas City. I'm getting some pretty heavy feedback. Is there a way we can? Okay, here we go. That's better. Jeremy Hegle with the Federal Reserve Bank of Kansas City. Sorry I can't be there in person today. I'm going to provide some information about broadband, which is a very timely topic right now. And before I get started, I do want to share just a couple slides about the Federal Reserve Bank of Kansas City and our work. Most people that know the Federal Reserve know of our work around monetary policy and bank regulation. I come at this work from the community development angle, but we are obviously based in Kansas City, Missouri. We have a little over 2,000 employees. This is our building, which unfortunately I haven't been in about 6 months. The Federal Reserve Bank of Kansas City is one of 12 reserve banks of the Federal Reserve System. We've been around for a little over 100 years. Most people don't realize, or not everyone realizes, I should say, that the Federal Reserve System is actually our country's third attempt at a national bank. The first two were given 20-year charters by Congress. There wasn't a lot of public trust in those. There was, the short version of it, I would say, is that there was, historians would say that there was concern of having too much power centralized in one location. And so when people look at the reserve system we have today, you see more of a federation style system. So we have the Board of Governors in Washington, D.C., and the Board of Governors are appointed by the President and approved by Congress, and they provide oversight to the 12 reserve banks that are spread out across the country. Each reserve bank has its own board of directors, and the board of directors appoints the bank presidents. So I'm an employee of the Federal Reserve Bank of Kansas City, as opposed to being a federal employee. So when it comes to community development, which is my area of work, there are some regulations that were passed in the late 70s that require banks to invest in the communities they serve. This is known as the Community Reinvestment Act. And through the Community Reinvestment Act being passed, the Federal Reserve System created departments of community development. And our work is really to raise awareness of issues that are negatively affecting low and moderate income populations, and convene stakeholders around advancing solutions to address those needs. So from a more philosophical perspective, our goal with community development is to help advance equity amongst lower income and underserved populations in both rural and urban parts of our districts. The Federal Reserve Bank of Kansas City has a Community Development Advisory Council, which you see here. And through this council, we meet with them formally twice each year, ongoing conversations with them throughout the year. And when we meet with them, we always ask them for their perspectives on what's happening in community development. We have a very diverse council. We have two members from the state of Kansas, Aubrey Abbott Patterson on the top left there is with the Hutchinson Community Foundation, and Nalima Parasker of Overland Park, Kansas. And this council provides a variety of perspectives from housing, workforce development, labor, philanthropy, healthcare, the skilled trades, and economic development are some of the big areas. And what was interesting is a few years ago, we started hearing issues popping up and that seemed to be rather disparate. Issues around economic development, education, and what we realized, all these things had something in common, and that is they all tied back to the baseline of it was digital equity, or the digital divide. So I ended up doing some research, some qualitative research, and reached out to and got perspectives from over 160 professionals, practitioners, to get a better understanding of what were the issues around the digital divide. From that, we ended up producing this report that's about 75 pages long, and it pulls from a variety of those perspectives, provides some innovative examples of what communities are doing to address the digital divide, provides some data and statistics and research, and helps provide a clear understanding of what the digital divide is and how to address it. So I'm going to share some statistics from that report today, and also a framework to help understand the digital divide. COVID-19 did not create the digital divide, but it definitely exacerbated it, as I'm sure all of you are quite aware. First, it's important to think of the digital divide or digital equity as having a three-legged stool. Broadband is a core component, and I'll speak a lot about that today, but broadband, getting people broadband without the skills and the devices necessary to utilize it isn't going to accomplish much. So first, I'm going to start with a few definitions that I think are really helpful to understand the topic. First, when we talk about broadband, it's important to recognize that that speed matters. As I'm sure many of you know, the federal definition currently of broadband speeds means that the internet connection has to have a minimum of 25 megabits per second download, so that's your consuming data from the internet, and upload speeds of 3 megabits per second. Internet below that speed is internet, it's not broadband, so it's an important distinction there. Symmetrical speed, this is important as more and more people are working from home, as students are learning from home, and it means that the upload speed is equal to the download speed. So going back to the broadband definition of 25.3, that was an adequate definition, that was an adequate speed in the days when people were consuming content, but trying to upload a homework or trying to video stream and upload that video and audio at 3 megabits per second is going to be challenging. We also hear about broadband availability and broadband adoption. It's important to note here that broadband availability means it's there in the ground. Adoption means that people have subscribed to it. So oftentimes you may hear that, you know, roughly 80% of people have, or 85% of people might have broadband service, but you have a much higher percentage where it's available. The difference here between availability and subscription typically is a matter of cost. So it may be available, but not necessarily affordable. Now, to help put things into context on the broadband speed part, I like to draw to an analogy of a car. I happen to like cars, and so if you want to think about what you can do with speed, with broadband speed, think about what you can do with different cars. If someone has less than 5 megabits per second speed, technically that would be internet, that would be technically a car, but it would be a car that looks something like this. It's not something that you're going to want to get out on the streets. It's something, you know, broadband speeds of 5 megabits per second that would be suitable for one device to be connected. It would be good for, you could, you know, surf the internet, but you're not going to be able to upload large files. You're definitely not going to be able to work from home with these speeds. You're going to be very limited. Now, if we go to what we currently consider the minimum threshold for broadband, which is 25.3, you're looking at a car like this. This is a car that you could drive around town with 1 or 2 people or 1 or 2 devices. You can surf the web, you can email, you can do some moderate video streaming. Technically, it's a car. You can get it licensed and insured, but you're not going to want to go cross country with it. You're not going to have 25.3, you're not going to be able to connect a lot of devices. So also when we're thinking about people working from home with students learning remotely, you know, the more devices that you connect, the more speed that you need. Once you get up to about 50 megabits per second, you're looking at the analogy of a 10-year-old Ford Escape. It's a respectable car. It's still probably going to be pretty reliable. You can get a few friends in the back seat, a couple friends in the back seat. Here in this scenario, you might be able to get, you know, 3 devices connected. You can do video streaming. You can do gaming. You are going to have a limited number of devices that you connect at these speeds. So if you think about, you know, 10, 20 years ago, most homes may have had 1 computer. Most didn't have more than that. Today we have, you know, our thermostats are often connected to the internet, and we have multiple cell phones and multiple computers. So when we're thinking about planning, we really need to be thinking for the future. And we really need speeds around 500 to 1,000 megabits per second. 1,000 megabits per second, that's known as gigabit speeds. And this is really preparing people, positioning people, not just for what they need to do today, but also what they're likely going to need to do next year or the following year. These larger speeds allow multiple devices to be connected and to go a lot further, if you will, in this analogy. Something else that's important is when you're talking to people about broadband, when you're talking to people about internet, it's important to recognize that speeds vary considerably by technology. Many of you might remember, say 20 years ago when DSL came out and it was blazing fast speeds. Well, as you can see here, DSL in the first column, at best, you're often looking at 15 to 18 megabits per second download speeds, upload speeds of 1 megabit per second or less. That's not even broadband speeds. Unfortunately, much of the rural parts of our country that are connected by internet are connected via DSL. So it was, it served its purpose, but it's no longer meeting the needs of the community. You'll notice that the speeds gradually increase. Over to the right is fiber optic, often referred to as fiber to the home. That's the large bus that I was showing you. Fiber provides much higher speeds. It tends to be costlier, but it also tends to be future-proof. So in terms of who has broadband and who has computers, the biggest divide tends to be by income. Obviously, rural communities, as many of you probably know, are less likely to have broadband, but those percentages drop considerably when we look at the income level. So right now, fewer than 2 out of every 3 lower income kids has both the internet and the computers needed for them to do distance learning. So it really puts a big strain on our educational system. Something else that's important to recognize is when it comes to who has broadband and who doesn't, unfortunately, there's widely known that we don't really have the best idea of who does and doesn't have broadband. The FCC, these numbers are a couple years old, but this still highlights the same issue. The FCC indicates that on these numbers, roughly 24 million people don't have broadband. That's now down to about 20 million, they would say. Compare that to a study that Microsoft did a couple years ago, where they actually looked at the speeds at which people were using their internet-based software. And according to that study, roughly 162 million people did not have internet that was operating at a broadband speed. Now, there's a couple reasons for this. One is that the FCC gets their information on broadband availability by asking the providers where they offer their internet services and at what speeds. Keep in mind that actual speed and that might be advertised, the speeds that might be advertised and actual speeds are not always the same. So if you have internet service and you have the plan that's say 100 megabits per second, the part that is often overlooked there is it speeds up to 100 megabits per second. So the actual speeds are quite often lower than what the advertised speeds are. Because of some of those issues with the discrepancies of mapping, federal funds are most always restricted to, federal funds for broadband, that is, are most always restricted to areas that are unserved. And so any area that's indicated as being served, typically that area is ineligible for federal funds. And some of you may have seen this campaign a couple years ago where the FCC had a mobility fund to expand wireless cell phone coverage across the country. And according to the FCC maps, the entire state of Kansas was completely covered. There were no dead spots in the entire state. And I'm not in the room with you right now, but I'm sure if I was, some of you might be rolling your eyes or snickering because of course there are dead spots. Almost every state has areas with inadequate coverage. the Kansas Farm Bureau launched a social media campaign called Connecting Kansas, where they enlisted residents across the state to download an app and actually do some speed testing, and validated that in fact there were dead spots in Kansas. The FCC accepted that, and some areas of the state were able to get some funding for that program. Now, thinking about this as an economic development issue, I probably don't need to spend much time explaining this, but we know that rural areas that are connected in the past decade or so have seen an increase in population of millennials. Areas that are the least connected, areas that are the most unserved, have actually seen a population decline. So I've had people ask me before, well, okay, how do you make the economic case that there's a connection between having broadband and growing populations and jobs? And as one of our Community Development Advisory Council members shared with me a couple years ago, she said that she is an economic development director in a rural part of Nebraska, and she said that her task is to retain young people and to grow jobs, but young people demand to be online, and employers need to have a broadband connection to conduct business. And if you don't have that, you can't grow your community. So we have a few updates in terms of broadband in Kansas. As many of you may have heard, last week, the governor announced the Office of Broadband Development. This is a new office that's really going to help streamline and organize broadband expansion across the state. The office is going to evaluate and report annually on the extent and quality of affordable broadband offerings in Kansas. And of course, affordability is a key piece there, because if the internet's available and it's $100, $150 a month to subscribe, obviously a large portion of the population won't be able to afford that, and we won't see the economic benefit, the educational attainment of having everybody connected. So the office is going to also develop strategies to facilitate construction of broadband infrastructure necessary to achieve functional universal broadband access for Kansas homes and businesses, and also develop and advocate for policies that make high quality broadband service more accessible and reliable in underserved and vulnerable communities. Along with that, the governor announced $50 million in grants. This is part of the CARES Act funding that the state of Kansas got, and they awarded $50 million of that to 67 projects through the Connectivity Emergency Response Grants. These projects are spread out all across the state. You can actually find a list. I meant to include a link here, but it's rather long to try to copy down. But if you search, if you're interested in seeing where those went, if you just Google Connectivity Emergency Response Grants Kansas, it will come up. Now, with this, those grants are going to internet service providers. They have to actually spend that money this calendar year, since it is part of the emergency CARES Act funding. And so that obviously can be a challenge for internet service providers to actually deploy that quickly. One thing that I found very interesting was the Hutchinson Community Foundation actually agreed to provide $215,000 in loans to help cover the required match for a company called IdeaTech. So the internet service providers that receive this funding through the Connect Emergency Response Grants, they had to come up with a match. So in this situation, the Hutchinson Community Foundation agreed to provide a loan to help cover it. And they were also through that able to attract an additional $225,000 loan and a $25,000 grant from the Kansas Community Investment Fund, which was a fund created through a partnership between the Kansas Health Foundation and Network Kansas. So a really innovative way for that community foundation was able to do some impact investing to help improve their community. So I just thought that was really noteworthy and thought I'd share it. Okay, so we talked about digital equity being a three-legged stool. You have to have affordable broadband, but you also have to have, of course, a computer, and people have to know how to use it. So I'm going to talk a few minutes about some of those other two elements that we see here. So as you might imagine, especially right now, computers can be hard to come by. They're in high demand, and they're not necessarily low cost. Some things that I think are really innovative and interesting. Some of these organizations that you see here are nonprofit organizations that will accept donations, used computers from employers. As many of you are probably familiar, employers often replace their computers in 3 to 5 year increments. So every 3 to 5 years, they are getting rid of their old computers. Sometimes those computers get destroyed. Sometimes they sit in a warehouse. And whenever the employer gets rid of those computers, there's always a concern about ensuring that the data on those computers gets destroyed or wiped. These are some examples of some nonprofits that accept those donations. They are certified to remove the data, and then they install new software and make them available to lower income folks and community organizations for anywhere from $50 to $150 a piece. So that was something that I was, when I was doing my research on the digital divide the past couple years, I thought was really intriguing. And so recognizing that the Federal Reserve Bank of Kansas City, we have roughly 2,000 employees, and we replace our computers every 3 years. We launched earlier this year, we launched the Employer Laptop Challenge to encourage other employers to join us in donating surplus computers, especially with so many students working from home, or I'm sorry, learning from home, adults working from home. It seemed like it was a good time to do our part in an innovative way to help address this digital divide. This project actually started as a pilot a couple years ago, where we donated 25 of our surplus laptops to an organization called Operation Breakthrough in Kansas City. It's an organization that serves low-income families. It provides Head Start, charter school, social services. What was really interesting is we followed up with the organization a few months later, and these two young ladies that you see on the left there showed me how some of the coding that they were able to learn. They were actually, their instructor was teaching them how to code by instructing them on coding video games. So they had a really simplistic video game that they had learned to code and develop. They were also able to go to robotics competitions and compete with students from more affluent suburban schools. That's something that I didn't realize, that in order to go to and compete in a robotics competition, one has to have a one has to have a computer to program the robot. So some of the computers went to a few of the moms. This is one of the mothers showing me her schoolwork. So in this particular situation, she had enrolled in a program at a community college, and a week into the program, somebody stole her laptop. She didn't have the money to replace it, and it's quite literally impossible to attend a community college this day and age without having a computer to do projects with classmates, to turn in your homework, and do the other demands of the educational program. So she was able to stay in and complete her degree. for this year, we actually expanded this initiative to donating 75 computers. And the idea pre-COVID was to develop some case studies of all the different ways that computer donations can help address community development needs in the community. And so some of the computers went to low-income housing for seniors, where they were able to get we're going to get some digital literacy, digital education training. Some went to, in this case, this is an organization in Kansas that provides transitional housing for formerly homeless youth. And so we gave them some of the laptops so that they can attend school, that they could work and just do everything else that we would expect to be able to do on a computer. So since launching the Employer Laptop Challenge in April, we've had roughly 2,700 devices that have been donated from other employers. Most of those have come from metropolitan areas like Kansas City and Denver. However, Durango, Colorado, which is a community of roughly 20,000 people, so roughly the size of Pittsburg, Kansas, they, when was this? I think in May or June, decided that they, wanted to drive some computer donations and to get computers to children attending the local school district. And so several employers got together. They did a big computer drive. They worked with a nonprofit refurbisher from Denver who agreed to drive down. You can see some of the computers there that they were able to pull together. And then the nonprofit refurbished those. And then they had a distribution day where the area employers partnered with United Way, the Boys and Girls Club, the school district, and local foundation. And families were able to register for a free computer online. They did a drive-up pickup. So you can see these are some volunteers that had the computers. You can see a car in the background there that was getting ready to pull up to get those computers. So this is something that I think is noteworthy just because it's another innovative way that communities are coming together to address some of these issues of the digital divide during COVID. Now, Jeremy Hill mentioned previously in his presentation about the change in lower skill, mid-skill jobs and digital skills. And right now, as many of you might be familiar, we have what's been referenced as a hollowing out of the middle class. We have lower skilled jobs, and we have lots of high paying jobs requiring degrees, but not a whole lot in between. Getting people digital skills is a great pathway to getting them into livable wage jobs. We know right now that the bulk of job growth is in jobs that require some sort of digital skills. It's not necessarily coding, it's knowing how to use Microsoft Office, use Outlook, database type work. These are ways that we can get people into livable wage jobs, and this is where we have most of the growth in our job sector right now. There are many examples of, you may have heard of coding boot camps, and I'm familiar with some programs where with 8 weeks of coding, somebody's essentially ready to be a coding apprentice, if you will, and can get a job at $15 an hour and build up their skills over time and get into even higher wage jobs. So digital skills, digital skill training programs are really important right now. Going back to the example I shared of some of the organizations that we donated computers to, one of them was the Perkins Library, which you see here. The intent at the time, pre-COVID, was an after-school coding program for youth, which you can see them here holding up the computers on the day we donated those computers to them. Obviously, COVID struck, and that kind of changed everybody's lives. Yes.
Thank you so much. This has been great. Can you wrap up within 1 minute?
Sure.
Thank you.
So real quickly, I just want to state that in that example, the library had to close. It was the only source of free computer access, free internet access in the community, and so the librarian was able to put the wireless network out into the parking lot. They ended up lending the computers out so that people can walk up, check out a computer, access the computer and the wireless network in the parking lot. There are other innovative stopgap measures like that. Libraries, offering hotspot checkouts. The last thing I'll say here real quickly is there are lots of innovative stopgap measures right now around the digital divide. We should celebrate those as being innovative stopgap measures, but not settle on that being the end solution. The end solution really should be us getting affordable internet, affordable broadband to all of our residents in our community and ensuring that they have the skills and the devices necessary to utilize it. There you go. That's the rest of my presentation. I'm happy to take any questions if there are some. And if not, Andrew, happy to turn it over to you or Jeremy Hill.
Thank you so much, Jeremy. I think that Jeremy Hill is having a few more issues on his end in Pittsburgh, so we're going to go on a quick break.
Could be a line queuing up for the elevator, right? Yeah, but you're only allowed one at a time in the elevator, right? I'm amazed how many people I see use the elevator in our building to go one floor. Yeah. I always figure use it or lose it. Jeremy, I've been made a presenter here. It's giving me a thing, show my screen. Should I assume click yes? Hopefully that's working there. So, very good. All right. Oh, I think it's a variety of issues. You know, so I think it's one of it's internet, one of it is, you know, computers are just finicky.
Well, it looked like that one machine just died.
Yeah,
Like
yeah.
the guy was talking about a discount.
That's not a good sign.
That's not a good thing.
Nope. Nope, not a good thing at all. So.
Well, I remember last year you kept yours short because we had some time issue last year.
I'm
You need to take your time and let somebody else.
No, I'm good at that, and I can be flexible. There was one year at the big conference in Wichita. This is before Jeremy came, and I did my presentation, and person who was like a couple persons before me went like double the time they were allotted. And so I was sitting there looking at my watch, and you know the whole thing was supposed to be done at 11:30, and it was getting to and Janet Hara at the time hadn't even, you know, she did her thing last. She did the final, and she was the main event, right? And so I was sitting there looking. It was already into when her time was supposed to start. So I went up and I said, you know, hey, I'm so glad to be here. Thank you so much. People who run PowerPoint slides, do me a favor. Would you go all the way to my last slide? And I jumped ahead to my last slide and I just said, this is all available. You can look at it, but I'm just going to give you the highlights. I took like 3 minutes and then turned it over and we got out on time. And I had the best reviews of anybody in the whole session. The only thing worse is when you're late afternoon and you're in the way of getting people out to the cocktail party, right?
That's right. You don't be between them and the drink.
Yeah, like I said, I feel so much for him. You really almost need a stage manager.
Yeah. Well,
right.
You know, like at an academic conference, you know, the chair always has to be the timekeeper too.
Yeah,
you know,
yeah.
They're waving something at you.
Yeah.
But that's just not really appropriate for a forum like this. But
right.
You do need maybe a clock or something.
Yeah. Yep.
Right in front of you, counting down.
Yeah. Well, it's but when you're virtual, you know, you get so focused.
Oh yeah.
I don't know if you've ever had. You probably don't haven't had the opportunity to teach in this world.
No,
but,
I haven't had to do that.
You know, when I've been doing classes that are live and Zoom at the same time, and students will send questions in the chat box and trying to respond to both and do that, it's just very distracting. One of the pieces of advice our instructional design folks gave is to actually have a graduate student there just monitoring the online students. And I did that for a while, but it you know, that's a lot of time. You know, that's an expense.
Oh yeah.
Right.
Yeah.
And so.
Yeah, they recommended us not to try to do the simulcast.
Yeah.
You know, don't be trying to do live in person and you have people remote at the same time.
Yeah.
I cannot imagine. Keep that.
Yeah. So, well, Jeremy, are you ready for us to go? Are you ready?
Okay. everyone would return to your stations, we'll go ahead and get started for the second half of our program. And it's my pleasure to introduce Dr. Stan Longhofer. He is the local and state real estate outlook presenter this afternoon, and he is the founding director of the Center for Real Estate at Wichita State University. Please welcome Stan to the stage.
I guess I can take my mask off now while I'm up here. So thank you all very much. It's a great pleasure to come out here again today. It's a beautiful day and a beautiful campus. We've been here now our second year at the Overman Student Center. Did I say that right? And it's a wonderful facility, so we're really grateful to be here. As he said, I am Stan Longhofer. I'm the director of the Center for Real Estate at Wichita State University. And every year we do our annual housing forecast. At your tables, you should have a copy. As a part of this forecast series, we do county housing market outlooks for 22 different counties across the state, including Crawford County. And while it's not a formal forecast, it gives you a snapshot of the current state of the housing market. I'd also mention that in the back of the room on the tables, there are copies of the housing forecast booklets that we do for each of the major markets across the state. And so if you'd like extra copies of the county outlook, or if you'd like copies of the Topeka or the Kansas City housing forecast, please feel free to pick those up at the back of the room when we're done. And I do have to give a big thanks. We wouldn't be able to put together these beautiful publications if it weren't for generous sponsors throughout the region. The Center for Real Estate receives no state funding whatsoever. And so I'm especially grateful to Security First Title. They're the sponsor of the Crawford County Housing Outlook, and it's because of them that we have this publication. And then I also need to give a thanks to all of the realtor associations across the state. We have a partnership with them whereby we poll all of the multiple listing service statistics across the state of Kansas, combine them together so that there are regular statistics available on housing market activity across the state. And then because of that, we have access to the data to do our annual forecast. And so we're grateful for that partnership. So last year when I was here, I had a slide that Jeremy talks about the economic forecast, and so I don't talk about the economic numbers, but I said, the underlying fundamentals in what will happen with the housing market were really, really solid. Mortgage financing is cheap and widely available, and labor markets were fairly healthy. But as I transitioned, I said, all of this could change fairly quickly. And I had no idea how quickly and how dramatically things could change. I don't think any of us could. The word unprecedented is trite right now, but that's because there really is no other word to describe the circumstances that we found ourselves in. So Jeremy's talked about the economic outlook, the variation in employment forecast he has based on all of the uncertainties in terms of the resolution of the pandemic and a vaccine for the pandemic, and also the political realities that we're in, which are even more unpredictable than they've ever been in the past. From a mortgage rate standpoint, however, what this has meant is that mortgage rates have gone from what were historic lows to even more dramatically historic lows. And the Mortgage Bankers Association of America puts out a forecast of the 30-year fixed mortgage rate. And right now they're forecasting that rate will remain below 3.5% through the end of 2021. And so it's just stunningly low rates. And what we're finding is that this is really having an increasing stimulus on the housing market. So what have we been seeing in housing market activity? This chart shows total home sales across the state of Kansas by month. And the red line in the middle is a moving average. So you can see through the seasonality. Sales go up in the spring and they tail off in the fall. But the underlying trend that we're seeing here is that home sales activity has been really plateauing for several years now. It's not increasing very much, it's not dropping. And we're continuing to see the same thing happening since the pandemic hit. Now you might say, okay, state of Kansas is great. What's happening in Southeast Kansas? Well, I've pulled those same numbers. This is the moving average of home sales in Montgomery County, Labette County, and here in Crawford County. And what you can see is that while Crawford County still is showing this kind of plateauing effect, not really dropping, but not increasing, Labette and Montgomery County have tailed off a little bit over the past year. And so the question is, why are home sales declining? And one thing that people often think is, oh my goodness, the pandemic, it's going to really cause a real drop in housing market activity. And we began tracking on a daily basis what was going on with new listings, contracts that were being written, and sales that were being completed in the housing market across the state. And what we found is that new listings did drop off pretty sharply in the midst of the pandemic shutdowns. But contracts written and sales that were being completed didn't drop off much at all. In other words, the primary impact the pandemic has had on the housing market has been to reduce the inventory or the supply of homes that are available from what was already an incredibly tight housing market. And so in this slide, what you can see is a number that we call the month's supply. What we do is we take the total number of homes that are listed as available for sale, and we divide that by the pace of sales over the past year. So if in a market you had 1,000 homes available for sale, and you sold 200 homes in a given month, then you would take 1,000 divided by 200 and say that you had a 5 months supply. Okay? We usually think of a balanced market as being between a 4 and a 6 months supply. That's the area where you have enough homes available for sale for buyers to look and see, but it's not so flush that it becomes a buyer's market. So that shaded horizontal region on here shows this balanced market. And what you can see is that for Kansas as a whole, we have been in below a 4 month supply, or what might be considered a seller's market now, for almost 5 years. And it's only gotten worse over the past year. Now, there's an interesting dichotomy on this chart of Kansas compared to the US as a whole. And you'll notice that for the US, there was kind of a spike in months supply during the period of the shutdown. That in part, that really didn't happen in Kansas, in part because real estate was deemed an essential activity, and so it was not forced into a shutdown in Kansas. And so home sales activity could continue to pursue, which I think was the right decision, and it was an appropriate decision for reasons we can talk about at another time. So how does that compare in Southeast Kansas? Well, what you can see is that inventories are always higher in Southeast Kansas than they are for the state as a whole. But even across Southeast Kansas, one of the things we've seen, especially in Crawford County, is that inventories have now dropped down to a place where we are also in what would be considered statistically a seller's market. The only part of the Southeast Kansas that we include in here that maybe is still just balanced would be Montgomery County, which is still at the high end of that 4 to 6 months supply range. So what is our forecast for home sales activity? Again, we don't forecast the counties, every county across the state, but for the state as a whole, we're forecasting sales to continue to plateau. Very slight increase in home sales this year, a 1% increase. But this increase is muted not because demand isn't strong. Demand is very strong. The primary reason home sales are not increasing at a more rapid pace this year is because there simply aren't enough homes listed and available for sale in most markets across the state. We're forecasting that sales will decrease slightly next year, 1.3%. Part of that is due to the continued inventory problems, but part of it is because we believe that demand will moderate somewhat next year as the ongoing effects of the recession are felt. So far, as Jeremy has discussed, the employment impacts and the impact on personal income has been somewhat muted, but going forward, especially where he talked about the manufacturing base in the state, that's going to start to have spillover effects in other segments of the economy, and we think housing markets will be impacted by that somewhat as well. But we're at such tight inventories to begin with that it's not going to cause a crash by any stretch of the imagination. Now, I mentioned that inventories are really tight. One of the things that's been interesting to see here is how this is different across different price ranges of homes. And so one way we look at this is we segmented, and these are arbitrary cut points, but we said, let's look at the low end of the market, say across the state, homes priced at less than $100,000. The real meat of the market, or the most desirable price ranges, between $100,000 and $250,000. Homes priced between $250,000 and $500,000. All three of those price ranges have continued to decline in their inventories and are really tight. But what's changed since last year is what's happened at the very upper end of the market across nearly every large market in the state. A year ago, I said, this is a very different market depending on whether you are in the upper price ranges or if you're in the more modest and main part of the market. Over the past year, inventories have tightened to the point where in some markets, it's actually almost becoming a seller's market, even for homes priced above $500,000. And I think that is primarily the impact of declining interest rates, coupled with the fact that it is the most affluent buyers who are the most insulated from the impacts of the pandemic. They are able to work remotely and to feel much more confident that they're not likely to lose their jobs. And so when you look at a confidence in their employment situation, coupled with interest rates that are unlikely to ever be this low again, this is a great time to move up and buy more home if that's what you're interested in doing. And so this has caused even the upper end of the market to get much tighter. As a result, home price appreciation continues to be very robust across most of the state. We're forecasting that Kansas home prices will increase by 4.8% this year and then increase another 5.7% next year. Now, that may not seem like a lot to people who live in California, but for those of us who live in Kansas, we know that's very rapid appreciation, a very, very strong appreciation rate. In your county outlook, you can see what's been happening in Crawford County. I'm sorry, I forgot to put a slide with that in here. I'm surprised I missed it. But the median sale price of homes in Crawford County is listed here. And you can see those median sale prices have increased quite a bit this last year as well. Kind of a nice little jump. The final number that we forecast is home construction activity. And given that we have very strong demand and tight inventories, for a number of years I've been saying you'd think that new home construction activity would begin to accelerate. And that hasn't been the case, in part because construction costs have been too high to really build homes in the most desirable price ranges. What we're finding, especially in the larger markets in Kansas City and in Wichita, is that home price appreciation over the last few years has finally put it in a place where new home construction can begin to occur at homes that are priced at least at the upper middle end of the market, if not the lower middle end of the market. And when you couple that with the historic low interest rates that I cannot repeat often enough, there are more buyers now who are saying, you know what? If I can go and get what I want and do that, and I can now afford it because of the low interest rates, that's pulling even more buyers away from the existing home market into the new home market. And so we're forecasting fairly healthy construction activity increases, especially in the Wichita and Kansas City markets over the coming year. So that is the summary of our forecast. Our entire forecast, all of the markets are available on our website, and you can access them at wichita.edu/real estate. And also on our website, you will see a copy of my presentation here today. So you're welcome to download this presentation and work with that. And I don't know if we have any time for questions or not, or if we need to move forward. I have a few minutes for questions. Are there any questions from here in the audience, and anybody at home? If you're there at home, please, I'm sure that our moderator here can help facilitate that. I see a question in the back, yes. So the question was about what do I mean by inventory when I'm talking about that? And I'm not just talking about new homes being constructed. Those certainly would be added to the inventory of homes available for sale. But what we really look at here is existing homes that are put on the market. And again, one of the things that we saw through the pandemic is that fewer potential sellers are putting their homes on the market. And what we anecdotally, we're hearing this back from realtors, and it seems to be true in across several different markets, is that people who don't have to sell are saying, you know what, I don't want a bunch of strangers walking through my house, despite the fact that it may only need to be for about 3 days because homes are selling so quickly. And so that's further limited the inventory that's available for potential buyers. Any other questions? Well, thank you so much. I always enjoy coming here. It's a wonderful time, and you all have a great rest of your day.
Stand. All right, I would like to introduce the next speaker, Taylor,
Okay. Thank you. Okay. Can you hear me? Is it on? Oh, that's for people online. I have to be up here. Okay. All right. Well, we'll come up here. I'll take this off. Can you hear me now? Okay, great. Well, welcome. It's great to be here. I am going to give you a quick update of the ag economy and specifically Kansas land values. And one of the reasons that I focus on Kansas land values is because that's the main base of assets owned by farmers. And so for lenders and for producers, they care very much about where land values are in terms of their balance sheet and what that allows them to borrow in terms of operating capital. So real quick, we'll go through the current economic conditions. I like to put this slide up because it gives folks a bit of a historical perspective on where we are from the state in terms of profitability of our 4 main crops. And what I'll do is I'll show you this first segment, which is from 2000 through about 2007. And this is profitability to wheat, corn, grain sorghum, and soybeans. And what you can see here is that the average farm in north central Kansas was breaking even or losing a little bit of money on these crop enterprises. And that really is pretty normal because these are economic profits. So this means that they've got a return on their machinery and a return on their labor and their management, and they hit kind of a break even. So there's no excess profits in the industry. And in a highly competitive industry, that's pretty normal. Now the next period is from 2008 through about 2014. And what you can see here is there were definitely profits in the sector. This again is the same calculation, but now we're making around $50 an acre pure profit. Now what do farmers spend their money on when they make money? Land and machinery, absolutely. I had one gentleman try to tell me that he spent it on his wife, and I didn't believe him. But land and machinery, that's the trick. So during this period, we're going to see land values going up during this time, and we're bidding up the price of land, and that is both buying it and renting it. Okay, so then all of a sudden we go from 2014 to 2015, and the profitability on these 4 crops doesn't go back to, quote, normal, but instead we're now losing $50 to $75 an acre on these crops. So what happens to land values here? What is our concern? That they're going to just tank, right? That we'll lose all of the value that we bid up. Well, farmers are eternally optimistic. So there was a lot of, well, it'll get better, it'll get better. And you can see this very last time, this last period, 2019, there is a little bit of profitability on a couple of our crops, but I'll show you where that profitability comes from in just a few minutes. Here's net farm and ranch income. The green is dryland crops, and the blue is the cow-calf side. And you can see that 2014 on the dryland crop side was about $90,000. The year before it was $140,000. And then in 2015, it was exactly $6,000. So we went from making a tremendous amount of money to making very little money one year to the next. So that 2015 year was a big shock to the system. Now we've recovered, and it looks like 2018 and 2019 are back to normal. But let's keep going. This is the distribution across the state of net farm income, and you can see there's quite a bit of variability depending on what part of the state that you're in. And most of that is coming from weather and the impact on yields, because we're generally getting the same prices for our commodities, and we have roughly the same cost of production, but yields are what will drive that variability across the state in terms of profitability. Now this is the crux slide of the presentation. This is showing you total net farm income, but breaking it out by how much came from farming and how much came in the mailbox. In other words, from government payments. Okay, so what I want you to see is that in 2014, most of net farm income was orange. That, in other words, it came from farming, from selling crops. By the time we get to 2018 and 2019, the majority of farm income is coming from government payments. And in fact, the biggest payment is what we call the MFP payment, which is the market facilitation payment. And that was President Trump's payment to farmers to make them whole again with the trade war with China. Okay? So a tremendous amount of government money coming in and supplementing. That's why 18 and 19's incomes, they looked like they were back to normal, but this is what is driving that. Okay? So some farmers are going to need that income, and they're going to need it to cover their bills. Other farmers are not going to be in that type of situation. Let's just show you this. This is a distribution of net farm income across farms. So instead of showing you an average, which is useful, especially over time, this shows you how things differ across the farms. And what you want to see here is that we have some farms that are doing really quite well. But we have a big chunk of farms, we have about 18%, which that's down from 21% in 18. But in 2019, we had 18% of farms that were making negative profitability. And if you take in that next bin, that 0 to 50,000, that's about 40% of the farms. Now, why do I care about the 0 to 50,000 range? Well, because of this. This is annual living expenses for Kansas farm families, okay? So if 40% of my farms are making less than $50,000 off of net farm income, and that includes government payments, then how are they covering their living expenses? This is where you answer the question. How do they cover their living expenses? Spouse works off the farm. And what's the most important thing that you can get off of an off-farm job other than a paycheck? Insurance. Insurance, the fastest growing expense among farm family living expenses. Let's talk rental rates for a minute. Like I said, land values will go up, but so will rental rates. So how have we adjusted to new profitability? Why do rental rates matter? Well, because on an average Kansas farm, about 60% of the acres are owned and about 40% of the acres are rented. So we really care quite a bit about those rental rates. And that portfolio of owned versus rented land changes over time for a farmer's career. When they're early on and they're younger, they rent more of their land because they can't afford to buy it. As they progress through their career, they buy more land, and then their proportion of rented land starts to go down. So we have to be negotiating for lower rents. That's one of the ways in which we can adjust to this new period of lower profitability, is try to get lower rental rates. And the trick with that is negotiating with your landlord, and that's a tricky thing to do. A lot of lenders are offering advice to farmers about how to do that, how to talk to landlords, and how to adjust to that new level of profitability. But it's kind of hard. I always tease my farmers because they spend a lot of time in the combine or in the tractor, and they're not exactly talking to people and developing their communication skills, right? So they have to work on this, on trying to negotiate. Let's just show you this. You can see the increase from a statewide average. I'm looking at the blue line for non-irrigated cropland. We had an average of about $40 an acre in 2007. By 2015, that was $60 an acre. Okay, that's a pretty big jump in statewide average rental rates for ground, and that's farmers competing against farmers for that ground. It's backed off a little bit, but not as much as you might think, given the profitability in the sector. So a lot of farms, what they've done is they've locked themselves into these rental rates with landlords in order to keep that land and keep the size of their farm where they can still try to make some money. If you walk away from rented ground, you've decreased the amount of ground you have to farm, which means that your average cost of production has gone up. And so it's really hard to walk away from rented ground when that's what's keeping your average cost of production down. This is rental rates across the state. I'm from Montana originally, so this was really interesting to me to notice that in the western part of the state, you could get ground for, say, 30 bucks an acre. But if you get out to Brown and Donovan County, you're looking at $150 an acre. The difference is precipitation and soils, okay, productivity. So that's what we see on rental rates. These are available at agmanager.info if you're interested in them. That's our website at K-State Department of Ag Economics. This is for pasture, and you can see in this area we have some pretty strong pasture rental rates because we have mix-wise, we have a lot more cow-calf operations than we do in other parts of the state. So there's some strong rental rates in this part of the state for pasture. We also have a lot of competition with hunting. I don't know if any of you folks are hunters, but we have really good hunting ground down here. And so a lot of farmers compete with hunters for land. Okay, let's do land values. So they are affected by profitability in the ag sector. And when we looked at that profitability chart at the beginning, we thought, well, maybe land values are just gonna tank. They're just gonna fall right off. But land values tend to adjust a little bit slower than profitability, and that's because we have very long run expectations in mind when we buy ground. When we buy it, we don't expect to turn around and sell it the next year. We want to keep it and pass it on to our kids, right? When I first started at K-State in 2011, land values were going up by 15 to 18% per year appreciation. Those are crazy numbers. You could buy a piece of ground and turn around and sell it a year or two later and make really good money off of it. Now we're looking at flat to slightly negative growth rates on those land values. So there's some variability that we're gonna look at. I'm gonna skip this one and move right here to USDA's estimate between 2019 and 2020. The estimated change in land values for Kansas was 3.7%. For pasture, it was down 1.4%. So we're seeing a softening of land values relative to where we have been. Here's another way of looking at it from 2007 through 2020. You can see the big run up in all categories of land between 2008 and 2015, and then we've backed off. But it didn't fall off a cliff. It backed off definitely, but hasn't necessarily fallen as far as we might have expected. And that's because farmers are, number one, they have long run expectations in mind, and number two, those government payments are keeping things afloat in ways that wouldn't otherwise if we didn't have them. Here's the rent to land value ratio. So we're looking at the return to owning land, especially if you're a landowner. That pushed down because land values were going up faster than rental rates, and it's recovered a little bit over the last year. And then what I want to show you is the USDA numbers come from surveys. So they survey farmers and ask them what they think land values are doing. I like to be able to look at actual land sales. And so what we did was we worked with the property valuation department in Topeka, which is part of the Department of Revenue. And we got land sales data from 2015 through 2019. So these are actual transactions of land, because Kansas is a non-disclosure state, which means that if I want to know what ground sold for, I can't just go down to the courthouse and find out. I have to be a realtor, I have to be an appraiser in order to get this information. So this was really great information to get. When I look at a piece of land and I look at how much it sold for, versus another piece of land, there are a lot of things that factor into why that piece of ground sold for as much as it did. And so we want to account for those things when we try to kick back a prediction of where land values are headed and where we've been. So we want to account for things like the county location and population density. If you're in Sedgwick County, then you're going to have a lot of non-ag pressure on your ag land values. So we want to account for that. We want to account for the size of the parcel. The bigger the parcel, the fewer bidders. The smaller the parcel, the more bidders. So actually you'll see land sales where the land price will be higher on a dollar per acre basis for a smaller tract of land. I check out the irrigated versus non-irrigated versus pasture, because those categories of land have different productivity levels. I look at average rainfall, enrollment in government programs, and we take out the value of improvements to have a bare land value, and I take out parcels that are under 40 acres because those tend to have a lot of non-ag pressure where people might just build a house on it and not keep it in agriculture. So the first thing I want to show you is the number of transactions. In 2015, we had pretty high number of transactions. In other words, the land market, the volume in the land market was going really well. In 2016, that fell back quite a bit. 2016, I think, was the first year where sellers realized, you know what, this market has pulled back, and we're not getting the prices that we were going to be getting if we had sold in 2014 and 2015. And so if they didn't have to sell, they didn't. We had a lot of no sale auctions where the highest bid was not enough to get the seller to let go of the land. And then we had a lot of ground go up for sale that just sat on the market and didn't go anywhere. And so in my data, I can't observe those no sales. I just have missing sales, right? And so we've recovered quite a bit. One of my concerns is that we're getting into a situation, when I talk to bankers, we talk about with this period of low profitability is restructuring loans. And so they're taking short-term debt, their operating notes that they use to buy seed and pay for that year's costs, and rolling that into a longer-term note to take advantage of lower interest rates and make that debt more manageable. But bankers have told me that restructuring is maybe the first step, but the second step after that is to sell off a piece of land in order to bring down your debt. And so some of this land sale is starting to be, it's not wholesale bankruptcies where we're selling the whole farm, but instead where we're selling off small parcels. So what we see is for non-irrigated land, a 7.1% decline from 18 to 19, which is my last full year of data, and I'll show you my estimates for 2020. So again, a bit of a decline, but we're not falling off the ledge. For pasture land, it's only a 1% decline, which is pretty much flat. So the market is holding up, and I think that has to do with low interest rates and government payments, keeping things from falling more than they would otherwise. I only get the data on a quarterly basis, and I usually don't run those models until I've got a full year's worth of data. But I went ahead and took the first 2 quarters of 2020 and said, on average, what's land going for? Now, this doesn't control for the mix of non-irrigated versus pasture, but it does show me that basically the land values in the first 2 quarters of 2020 have not fallen dramatically. Now, there was a concern because a lot of land sells through auctions. And what do you think happened to auctions once COVID hit? All of those folks from the local community who would normally show up to have coffee and donuts and see what the ground sells for are not coming out, right? Except I did talk to one guy in Quinter. I don't know if you're familiar with where Quinter is. It's out towards Colby, but he said they have nothing better to do, so they still go to auctions. But for the most part, auctions have gone online. And for a lot of folks, the bidders now are not locals, but they're coming from out of state. And so that has kept the land value, the land is still selling, but it's not selling to the same people that it might have sold to a year or two ago. So let me show you this real quick. These are long run values. This is Iowa in the blue and Kansas in the red. I always tease my students when it comes to, you know, your history lesson of coming in the wagon trains coming across the United States and how your family should have stayed in Iowa if they stopped there as opposed to continuing to come on to Kansas. You'd have higher valued land. But if I change the axis so that we have the ability to see the comparison of how these land values move, what you notice is that what Iowa and Kansas have in common is that they're both driven by agriculture strongly, and they both moved in the same way. Now, some of you folks lived through the 70s and the 80s and know that farming was really tough in the 80s, okay? We had a good run in the 70s, and then you can see that drop off in the 80s where we lost quite a bit of land value, and we had a lot of bankruptcies and a lot of farms being sold. Then we moved through a period from about the 1990s through about 2002 where we were on a slow and steady rate of growth. It was a pretty normal period. And then starting in 2005, we started to pick up, and by 2008, we just launched in terms of changes in land values, that growth rate. So we still have a lot of room to fall back if we're going to fall back in the same way that we did in the 80s. So there's still room. We built up a lot of equity and a lot of value in that land that has the potential to sort of cushion us if we fall a little bit more. But we're keeping an eye on this because that's what's tricky is understanding whether or not these land markets are going to stay resilient with the amount of uncertainty that we've had. I don't like to get political, but I will say this about government payments. The current administration certainly gave plenty of money to farmers, and some would argue had an incentive to do so with re-election coming up. If the current administration stays over into the next 4 years, how much incentive do they have to pay farmers, you know, that kind of money? And then we don't know where on the Democratic side what that kind of government support would look like for farmers, because this is all ad hoc. This is outside of the Farm Bill, which Congress puts together and has payments in it too. But all of the government, most of the government payments I'm talking about over the last 2 years were ad hoc. So that's going to be a little bit tricky. There's some resources available online if you're interested in land values, and I will end right there. So I have a few minutes for if you have any questions. Yes, Dan.
When the auction, state buyers are buying land, so are they buying hunters buying land, or is it what are they doing with it?
Right. So what are those out-of-state buyers doing with that farmland? Well, they are still coming back in, and what they're doing is they're looking for a farmer locally to farm it for them. So this isn't folks moving to Kansas to farm. But they're taking the, land values are stronger in the Corn Belt, and some of those folks might be leveraging that value to buy ground in Kansas. The interesting thing is Kansas always looks like a good deal when it comes to farmland. But if you farm here, you know that the volatility in our weather patterns adds risk. And that risk is built into our land markets. So it's always interesting to me. I wonder how much they understand about Kansas farming when they go to buy a piece of ground here. But what they're doing is they're becoming out-of-state landowners.
Government, part of the government payments is really because of trade issues. So the change administration's office for some of the trade barriers.
That's
I don't know the time when I don't know what
right.
recently. Some of the government payments are not easy. Trade free, or is there still issues on the pricing of our local market that will still be needed?
Well, the argument is that we may have pushed a few buttons with China, and that they still need our beans, but they can be pretty stubborn about where they buy their beans. And So they may not buy from us simply because of what we've done. Now, we change administration, you could change that relationship, and that might improve things. But there's a lag between what an administration does in terms of trade talks and then what actually happens with purchases of crops to bring those. And I would be remiss if I didn't say one of the sort of, I would call it controversial aspects of those MFP payments being made because of the trade wars. We were also having record yields, and record yields push down prices, right? Because we have too much inventory. And so at the same time that we had trade wars, we also had record yields. Both of those were pushing prices down. And so there was kind of a controversy over, well, how much of it is trade related and how much of it is just too many crops. So yeah, those things could change with the new administration. Right. Right. That's a good question. I don't know. It depends on who you ask as to whether or not they're consuming what we expected them to. I think that they've picked up some of their purchases, but we're still not where we would like to be. So, yeah. Well, thank you very much. Oh, one more quick question. I think when it comes to sellers, there's two things going on. When it comes to sellers, they want the highest bid for their land for the most part. And they're not going to be too picky about who buys it, especially if they get a good price. But we need to remember that about 80 to 85% of the land, ag land that gets purchased is purchased by farmers. So it's being bought locally. And our land markets are still very local in nature. So even with out-of-state buyers on these online auctions, it's still not a majority of the land that's being sold. There will still always be a lot of handshake agreements and land being transacted that way. And so it will still stay very local. Thank you guys for your good questions.
All right, thank you, Mykel. Just like we had two Jeremys, we have Mykel for the program this afternoon. So I want to introduce the speaker, my colleague, Dr. Mykel.
For people online, people online can. It's just for
Please welcome Dr. Mykel.
Thank you, Dean Grimes. I am going to start about, okay. I'm going to start talking about the great economy and the region just a little bit before I move into the local economy. Now you can see that, hey, how do I do the laser pointer? The laser pointer is not very bright? Okay. And I use my own. Once a scout, always a scout, right? Now you can see that at the beginning of the year, the national economy was doing really, really well. There were actually more job openings than there were unemployed people. Now then COVID-19 hit, and in April there were 4.6 unemployed people for every one job opening nationwide, and then it declined. And the latest information we have shows that it declines quite a bit, and hopefully we continue to see that decline. Now, if you look at the portion of the labor force that was working in March, actually in February, that since then applied for unemployment, then you can, and that includes, the definition was expanded, and that includes also self-employed and some other groups now. So it's not unemployment or anything like that, but it's a good indication on the problem we have. 27.9% of the local workforce had filed for unemployment, but that is well below the statewide and the regional one. We belong to the West North Central region and the nationwide. Now, if you look at unemployment rates, then you can see that we are well below that of the state of the nation. And the reason for that is that this is a service-based recession, and the proportion that local jobs having services is much less than nationwide. And by the way, these jobs are usually not paid very well. So our low-paid workforce is actually doing a little bit better than nationwide, which is good news. Now let's look at what's happening in the local economy. And if we start with number of jobs, then you can see in the 2015-2019 period, the number of jobs increased 1.6% locally. It declined in southeast Kansas, but they increased 1.9%, and it was very robust nationwide, 6.4%. But if you look at wages, then wages are growing really healthy locally, faster than in southeast Kansas and statewide, although it's a little less than nationwide. Now, our labor force and workforce is substantially blue collar, and it lends itself well to manufacturing, and our local blue collar labor force is better educated as it relates to some people that have some college or skills than the national blue collar labor force. And if you look at the impact of the industries on the local economy, and we look at the combination of number of jobs and wages, then you can see that information pay $48,623, the highest wages in the area, but it only has 297 jobs. So overall impact on the local economy is not that much. If you look at manufacturing, it has the next highest wages locally. It includes, though, overtime of $43,461, and it's the third biggest industry locally with 2,600 jobs. It pays higher wages than professional and business services, and has more jobs also than education and health services, financial activities, natural resources, and mining and construction. It pays higher wages than trade, transportation, and utilities, although it has less jobs. It has better wages than government, all level. Obviously, there are good jobs within government, like in federal government. They pay really well, but most of the government jobs are local, and they only pay on average maybe $30,000, which is not very high. And then, of course, other services, and you can see leisure and hospitality has the lowest wages, but they have 22,000 jobs. So overall, manufacturing is the backbone as an industry of the local economy, and one of the most important industries locally. Now, if you look at what's happening in 2020, then you can, and by the way, I'm using the first quarter because that is the latest information we have. And And there's a 6-month lag. All the counties that have less than 70,000 are put on the back burner by BLS, and we are not going to have the second quarter until December. But you see, the U.S. had a job growth of 1%, statewide has a job growth of 0.5%, and the micropolitan area had a job growth of 0.3%. But if you look at wages, the wages are growing by leaps and bounds locally, 5%. That is much higher growth than both statewide and nationwide. Now, if you look at what types of jobs are growing, then all the job growth came from the goods producing industries, all of it. And you can see that as a super industry group, they pay the highest wages, and there was a phenomenal growth in wages. There was a phenomenal growth in wages of 7.1%, and obviously that is mostly manufacturing. So manufacturing is extremely important for the local economy. Now, there seems to be a considerable optimism about the local economy by people in the area, and you can see that the number of new businesses increased 1.7% in the micropolitan area and 3.4% in the city of Pittsburg in 2019. That is a testament of how optimistic locals are about the economy, because if you start a business, you typically take out a loan and you have to put your house up as a collateral. And if everything goes down the tubes, then you probably lose your house and you might have to file a bankruptcy. Now, if you look at the gross domestic product growth locally from 2015 to 2019, then you can see it increased 16.8% in the micropolitan area, well above that of the state and the nation. So the local smokestacks are really cranking out value. But we have a major problem, though, and that is there is such a big chunk of local jobs that is filled by commuters. The census states that in 2017, almost 65% of all the jobs in Pittsburgh were filled by commuters. The Chamber of Commerce and Kells College of Business and Cooperation did a study on the major employers in 2016, end of 2016, and we found that 70.9% of the local jobs are filled by commuters. Now, it shows that Pittsburgh really is the engine of economic growth in the region. So it's not a surprise that we have a lot of people commuting in, but this is just such a big proportion of total jobs, and it's a major concern from an economic development standpoint. Now, we also found out that 58% of all the commuters commuted in from the county but outside the city, but 42% came from other places or other counties in Kansas or other states. Now you can see here is the problem. The higher the income, the more likely it is that the job is filled by a commuter at the major employers. Now, overall nationwide, on average, 60% to 70%, of course, depending on industry, or total revenues or sales for businesses goes in paying wages and salaries and proprietors' income. These are wages to the entrepreneur. This is not stock income. So you can see the level of wealth and resources that are leaking out of the area. 2 other counties in Kansas and other states. Now, we found out that 53% of all the commuters wanted to live in Pittsburgh in the study, but decided because of housing issues. And back in 2016, and I reported on this in 2017 at the Pittsburgh Economic Conference at that time, I looked at the housing market and I thought, what can be wrong? What is wrong? I went on Realtor.com and Zillow, and guess what? I found a house. This came up in Joplin that sold for 160,000, brand spanking new, good looking, and then a similar priced house looked like this on Zillow. It was something really wrong with the labor market. I mean, with the housing market back then, locally. Something really wrong. One of the things is that 55% of all homes at the time, housing structures, residential housing structures in the area, 55% was less than were more than half a century old. 55% of all houses were more than half a century old. Now, I have to say that the local leadership is very responsive to issues and problems that come up, because since then, what has happened? There have been numerous housing developments pushed by the city, and they've been a catalyst for initiatives, housing initiatives, and as of now, there are 10 housing developments with dozens of homes that have been either completed or are still active or in the pipeline. Now, I have to say, for a city of 21,000, this has to be some kind of a record nationwide to have all these housing developments in the pipeline. And after listening to Stan, I was thinking, man, that's a good thing. If the housing stock is, available for sale is really, really shrinking. Now let's look at local incomes, household finance, and retail sales. Now the first thing that stands out if you look at estimated per capita income is the low per capita income in the Pittsburgh micropolitan area. But now we know why, at least partly. So it's a big chunk of the wealth that leaves the county and the city. 40% of all the jobs at the major employers commute from other counties or other states. Now, but it has been growing by leaps and bounds, 16.3%, well above statewide and the US. And we can see, no surprise then, that 9.5% of all households in Pittsburgh and 8.5% of all households in the micropolitan area were added to the middle income bracket during this period, well above that of the state and the nation. And good household finance condition has to show up in credit scores. And according to Equifax, 72.3% of all adult individuals in the micropolitan area have a prime FICO score. That's the highest level in the recorded history of that indicator on Fred. Now, bankruptcies go also up and down, but look at this. The per capita bankruptcies are only half locally of what it is statewide and nationwide. So really what must have been happening is that our household income conditions have been increasing all under the radar. I'm not sure like the greater community knows about this, which I think is sad, because we really have been gone through a period of a lot of improvement. And it turns out that the city is also a consumer city. According to Kansas Department of Revenue, then in 2019, if all retail sales locally were purchased by people that live in Pittsburg, then the population in the city had to be 86% bigger. Now we estimate at KELS that over 40,000 people visit the city on a regular basis for retail sales. And it shows that the city is a very important retail trade center in the region. Now, the taxable sales have been healthy, relatively healthy, and increased between 5 and 6% in the city last year. This is pretty good. Now, all this, I would say, improvement in the local economy and the economic activity locally has to show up in real estate. And I was thinking about that too when Stan was talking. In 2019, according to the Pittsburgh Area Association of Realtors, then home sales in the Pittsburgh metropolitan area increased 19%. And median house prices went up 29%. That has to be a record too, nationwide. I mean, it is just amazing. Now, let's look at commercial activity. We know that investment is extremely important because if you don't build the factories today, we are not going to produce more tomorrow, and the standard of living is not going to go up next year. Now, I am using a lot the period 2015 to 2019 because in 2014, 15, or 16, most of the local indicators started to improve for some reason. Now, commercial building permits have been really healthy, going up significantly some years and so forth. But if you look at 2020, it continues to be healthy. They are at 95% this year. 95% in the city. So there has to be, I mean, just looking at this anecdotal evidence, then it has to be a lot of some kind of optimism below the radar that's driving all this. Now, and here is another record that I think must be a national record too for a city that has 21,000 people. In this period, 2014-2019, 5-year period, almost $500 million was invested locally. $500 million. I mean, the level of economic activity locally has just been increasing by leaps and bounds, but for some reason it's been a lot below the radar. You don't read about it in the Morning Sun or the Morning or the Joplin Globe for some reason. $500 million almost in 5 years. I mean, for a city of 21,000, it has to be some kind of record. Now, included in that is about 10 million that was invested in laying fiber optic cable to increase access to the internet on high speed, bring the city into the 21st century. Now, all this investment has to affect local land prices. Must. And indeed, it seems to be happening. In 2015, per square foot, the median price of commercial land locally, according to Jones Heritage Realtors, which is the authority of, I would say, commercial real estate locally, was 5.7%, and it increased to 7%. I mean, in 2019. I mean, that is a sizable increase. It's a very, very healthy increase. Now, of course, this is based on sales during those years, but that's the best information we have. Now, let's look at the lodging industry really quick, because it's a special industry. Every dime in revenues in the lodging industry is a fresh cash flow from the outside that can be used locally to improve the economy. We are not recycling any local money. So here is another record that I think must be a national record, honestly. We had a 54% increase in revenues, 54% increase in revenues in the lodging industry from 2015 to 2019. How many cities nationwide do you think had 54% increase? Not many. But of course, in 2020, revenues have plummeted. But the lodging industry, though, is not one of the hardest hit industries in the tourism sector. I saw on TV the other day that they were talking about the cruise ship industry, and the second quarter's revenues in 2020 were down 98% from last year. God help that industry. I mean, that's terrible. Now, so if we have all this improvement in the local economic activity and all this growth in and improvements, so what does Pittsburgh have to offer people that move here? First of all, recently, or in the last 1 or 2 decades, there have been a significant studies in the regional economic literature that have shown that high-skilled and educated people are moving out of big cities, and they want to go to cities that have rural setting, but also have some urban amenities. If we look at the Pittsburgh area, then we have 261 retail eating and drinking establishments, 2 performing arts centers. We have 11,910 capacity NCAA Division II football stadium, 3 golf courses, Philharmonic Orchestra and Opera, and revitalized downtown with over 40 specialist stores and bars. Now that is important, because when you get a prospective employer, when a prospective employer goes to a new city, they always go downtown. And if the downtown is dilapidated or dead, they run for the hills. Now, the natural amenities we have are 14 parks, walking trails and biking trails all over the area, and access to 8 major lakes and rivers within 1-hour drive. Also, U.S. News and World Report did a study on communities nationwide in early 2019, and they learned the Pittsburgh metropolitan area into a group called Urban Up and Coming. And there were 833 communities in that group. And according to U.S. World News Report, U.S. News and World Report, they found that the Pittsburgh area had 36.1% greater access to hospital beds per capita. If there's something that COVID-19 taught us, then it is that access to a good healthcare is a significant quality of life indicator. And we are going to find out that the cost of healthcare locally is well below the national average. 3.1% higher spending per student in the high school, 6% higher high school graduation rate, 15.4% less violent crime per capita, 7.3% greater job diversity. That must be because of the university, and 3.3% per capita better access to the internet. Now, talking about how important it is to have a downtown that is vibrant and lively, then we have 29 ongoing or recently finished revitalization programs downtown Pittsburgh. Honestly, I think that is another record nationwide. I mean, how many cities with 21,000 people are going to have 29 active or recently finished revitalization program downtown? So the level of economic activity is just amazing in the last few years. Now you can see that the cost of living is well below the national average. Now let's look towards the future. And let's look at the strengths to start with. Well, we have a pro-growth leadership, strong economic development, and strong partnership between the city and the chamber and the local communities around. It's very, very important to have pro-growth leadership, and we certainly do. One of the things that we found in the study that we did in 2016, we asked people that lived in Pittsburgh and had worked here to list what they wanted to see. 17.3, I'm talking about how responsive the local leadership is. 17.3% wanted more activities. We had a lot of activities since then, including Axstrong downtown. 22% wanted more restaurants. We had a slew of restaurants moving in, including Colton's and Jimmy's Egg and some others. 17.3% of the locals wanted more internet infrastructure. We had almost $500 million invested in the last 5 years. And 21% wanted more shopping, and I think we had some more shopping like Walmart Market and so forth. Now let's look at the weaknesses. The major weakness that we have are the public schools, the ranking of the public schools. Now, the local high school is ranked number 4, 4 out of 10. I would not, if I had to repair my car, I would not go to a repair place that was ranked 4 out of 10. Now, last year, they were ranked 2 out of 10. But they've been improving, which is good. But it's not enough to have all this quality housing and all these improvements, all this infrastructure and all this stuff. It might not be enough, because if someone gets a job in Pittsburgh and has a family with 2 or 3 kids, all of us love our kids and we want them to graduate from a good high school and go on to a good college. And even if a person finds a nice home, affordable home in a good neighborhood and so forth locally, they might locate somewhere else, like in, say, Carl Junction or whatever. They have better rating of the high school. The other is population growth. We had a negative population growth. However, due to all this, I guess, I'm guessing here, but it's plausible, due to all this level of economic activity and improvement, and the perception of the city really is probably changing, the population growth is getting better. And for the city of Pittsburgh, the population growth situation is better. And we actually had 0.2% population growth in 2019. So over time, we've seen all this significant improvement in local household finance and almost every indicator that you look at since 2015 or so. Now, here is the problem in a nutshell. Like if you look at this, between 2011 and 2019, we had a 4.8% job growth locally. But the labor force declined 2.1%. What does that mean? This is for the micropolitan area. That means 40% of the wealth that was created from these jobs went outside the county to somewhere else. Or maybe not quite 40%, but a big chunk of it. Why? Because on average nationwide, 70% of revenues for businesses just go in paying wages. And if those wages, and we know the higher the wage, the more likely it is that is filled by a commuter. I mean, this is an extreme economic development concern. All right. So overall, I would just say the local economy was on the cusp of taking off in early 2020, and it has been kind of improving for some years now, and hopefully we are going to land on our feet after COVID-19 and continue where we left off. So does anyone have questions? Well, 58% of the jobs, were filled by commuters that came from within the county, but outside the city. So 42% of the commuters are going to come from outside the county in Kansas or from other states. For example, we found that 25.5% of the jobs that have 90,000 or more are filled by people that come from other states, mostly Joplin and some from the Miami area. And only 25.5% of the people that had the jobs in Pittsburgh that paid 90% or more lived in Pittsburgh.
About where those visitors and guests are coming in that are supporting the lodging industry?
Well, that is such an improvement in revenues in the lodging industry. Like I said, that has to be a national record, 54% in the 2015-2019 period. Now, there are two major reasons, I think, or three major reasons. First, of course, is that the area is becoming more attractive, and I guess the perception of the area is changing so that now it's a location that's worth visiting. Then, of course, we had the Plaster Center come online, which is a track and field center. Now it's one of only 15 track and field centers nationwide that has a 300-meter indoor track. And because of that, there have been a lot of national conferences and meetings that came to Pittsburgh. And of course, a lot of people that visited because of that. Then, of course, we had, there's a lot of people locally that have used the Plaster Center for local meetings because at this point in time, we don't have a conference center. And for example, Flag Church, I believe 3 or 4 years ago, brought in 600 people for 2 days. Almost all of them from outside Crawford County. Many of them came from all over the U.S. And then, of course, you had the Kansas Casino. When it was being built, the projection was that there would be 500,000 visitations a year. I don't know how that panned out, but I'm sure that we have a lot of people here also because of the casino.
Do you have any other questions for Mykel?
Okay. Thank you. Yeah, let me take this.
All right, I'd like to thank all our speakers today. Appreciate their time, their effort, in making today's program a success. Let's give them all one round of applause. Before we close, I'd like to thank all members of Kansas City Mountain Capital team. The team was established in 2015. It consists of a community of business leaders across industries all around the state. The team meets quarterly to discuss local economic conditions and outlooks affecting their communities. Members receive data specific to their community and ensure the dialogue about their respective industries. To consider joining, please view the KEOT packets located around the room and talk with one of the members listed in the packet. We extend our sincere appreciation to all our current Outlook team members. Again, thank you for attending today's conference. We hope to see you again next year. We apologize for the technological interruptions and delays, but we thank you for your patience and your attention. On your way out, please help us recycle by placing your name tags and providing drop-offs. See you next time. Thank you for being here.
Oh, yeah. Yeah. Yeah.